करो।
Welcome back. You're still tuned into Markets Today on CNBC-TV18. Let's go to the rest of the headlines that we are tracking for you now. The fourth headline now. Telecom stocks surged in trade today as JP Morgan flagged uncertainty of tariff hikes in 2023 as a negative for the sector. The brokerage has also said that lack of tariff hikes could lead to a de-rating. Reema Tendulkar is standing by with the details of this note. Reema.
Thanks so much for that. You know, the elephant in the room when it comes to the telecom sector and its performance is going to be whether we are going to see a tariff hike in this year. And according to JP Morgan, there is no tariff hike coming in from the telecom operators this year. It is pre-election, inflation is hurting consumers, and they're saying it will be difficult for telecom operators to do another tariff hike because the previous tariff hike of 20% had resulted in heightened churn. Even last year, there was a lot of hope that telecom operators will do a tariff hike, but that got pushed back as Bharti Airtel and Reliance Jio decided to focus on their 5G rollout in order to get the first mover advantage. And even this year, in calendar year 2023, both Bharti and Reliance Jio are going to be focused on rolling out 5G services and expanding their coverage. Now, when it comes to 5G pricing, right, 5G can command premium pricing over 4G, but according to JP Morgan, that's not going to happen anytime soon. Right now, at least, both the telcos have offered 5G on the existing 4G plan pack, and they say there is no premium pricing for 5G, at least till there is a critical mass adoption. And if there is no tariff hike which comes through in the next 6 months, it could come in as a big disappointment and Bharti Airtel stock can derail. In the event that we do see a tariff hike, according to JP Morgan, the quantum remains uncertain. Back to you.
All right, Reema, thank you so much for all those details. In fact, let's continue with this theme. JP Morgan also downgraded Bharti Airtel, pushing the stock 4% lower in trade today. The brokerage maintained that high capex, price repair delay and lack of 5G monetization can halt industry returns. Nimesh Shah is here with more details on this one. Nimesh.
That's right, and that's the reason why Bharti is the biggest loser today, as JP Morgan has today downgraded the stock to underweight from overweight, and they've sharply cut the target price to 710 versus 860 earlier. Now, three specific reasons why why JP Morgan has downgraded Bharti Airtel today. One, higher than expected capex. Two, delayed price repair, and three, lack of 5G monetization. In fact, JP Morgan believes that Jio's focus on high-end consumers would mean that there is a higher capex for Bharti Airtel to defend the market share, and competitive pricing in 5G would delay the free cash flow and return on invested capital. Now, at the current market price, JP Morgan believes that the stock is baking in a modest FY24 estimated capex, 10% tariff hike, and a continued ROIC expansion. All three looks difficult in the current environment, and hence a big downgrade on Bharti Airtel to underweight from overweight, and they've sharply cut the target price now to 710.
Okay, Nimesh, thank you so much for those details. So that's all about the telecom sector. And let's stick with Bharti Airtel now. Ashwini Agrawal of D-Meter Advisors says that the stock has no pricing pressure concerns as of now. Listen in.
It doesn't appear to me to be very logical to say that there will be intense price competition between these two players for market share, which is harmful for both of them. So let's see how it evolves. I mean, historically, that what we've seen anywhere else in the world, and even in India, if you just think about what's happened over the last year and a half, is that pricing competition tends to be a little reduced when you have just two players or three players competing for market share. So I don't share the concern on pricing pressure right now.
Right, from telecom, let's move on to the IT space. The IT sector perked up after JP Morgan released its estimates suggesting that Street expects better margins and lower attrition going forward. Reema is joining us with all those details. The IT pack did really well in trade today.
Thanks so much for that. So the IT sector is doing well today, and one point that we would like to highlight is that even though the revenue growth for IT companies will moderate in FY24 and FY25 to high single digits given the macro uncertainty, tighter technology budgets, clients being under stress, the EPS growth for the large cap IT companies is still going to be in double digits for FY24 and FY25. The JP Morgan estimates for the EPS growth for the top 5 IT companies are on your screen, and you would see it ranges from between 10% going up to even 18%. And remember, ultimately, valuation is a function of the EPS, of the earnings growth. And here, earnings growth will still be in double digit. The reason for why, despite revenue growth being in 6 to 8%, why will we see a bottom line growth much faster? And that's because margins are expanding on the back of easing supply side situation. Attrition, according to TCS, has come down by 600 basis points on a quarterly annualized basis. Subcontracting costs will start to decline, so margins are going to be supportive, which will drive an EPS growth of double digit for the IT companies.
Okay, all right, Reema, thank you so much for all that. Moving on to the fifth headline today, Adani Wilmar gained 2% today on the back of a healthy volume growth across segments in the third quarter. The company says that growth has been broad-based across both urban and rural towns. Mangal Malu is here with the fine print on the company's business update for quarter 3.
It's a decent update coming in from Adani Wilmar. In fact, for their third quarter, the overall revenues of the company grew in high single digits. The mainstay of the company, the edible oil business, actually showed high single digit volume growth, but because of the oil prices declining after a big rally that we saw in them last year, we've seen the company pass on those prices, as a result of which the revenue growth has been low single digit itself. Importantly, the food and FMCG business of the company, which is going to be the margin driver for them, has actually grown in mid-40s as far as revenues are concerned, and about 20% in terms of volumes as well. The industrial chemicals of the company also showed high teens sort of growth. The management has said that the demand was extremely strong on account of festive season, has indicated that both the rural and urban areas of the company have been doing well, but urban saliency has been higher. For the oil business, if you strip off the weakness in industrial demand, the consumer demand has been extremely strong, and out there too, revenues have been in double digit, as a result of which the stock ended higher in today's trading session.
All right, that's Adani Wilmar for you. Let's move on to the pharma space now. Aurobindo Pharma was in focus today after CNBC-TV18 learned that the company's plant in Telangana is under inspection by the USFDA. Let's get in Ekta to tell us more about this.
Well, yes, Aurobindo was in focus today. I do understand from my sources that the Jadcherla unit, which is basically in Andhra Pradesh, is getting inspected by the US drug regulator. The inspection is expected to have begun this week and is expected to be a normal inspection or routine, considering that this plant was last inspected around 3 to 4 years ago. It is around 2 to 3% of total sales for the company. It manufactures oral solid dosages and does not have any kind of compliance issues at this point in time. So important to track. In the next couple of days, we will get an indication in terms of how this particular inspection has panned out. We did reach out to the management. They do not have a comment on the story.
Okay, so Ekta, we will actually ask you to hold on, because Sun Pharma is also in focus after the USFDA issued a warning letter to the pharma company's Halol facility. Tell us more on this one.
Well, yes, Sun Pharma was in focus today on the back of a couple of news pieces. One was the warning letter which was issued to their Halol manufacturing facility has now become public. It was uploaded on the USFDA site. A couple of key important takeaways from that was the USFDA indicating that the firm failed to establish and follow appropriate written procedures. There was a failure to thoroughly investigate any discrepancy or failure of a batch. Failure to clean, maintain, sanitize, sterilize equipment, which is basically important for drug manufacturing. The USFDA has pointed out ineffective quality systems, and a CGMP or a third-party consultant is recommended. Remember that this is largely in line with expectations, because Sun Pharma had communicated that the Halol plant was placed under an import alert on the 7th of December by the USFDA, and they were subsequently issued a warning letter on the 15th of December for this particular facility. Separately, we did have brokerage notes on Sun Pharma as well. Jefferies, for example, wrote on Sun, they believe that the overall domestic formulation and CRO, CDMO space have structural growth drivers. They believe generics is a tactical play. According to them, their top picks include Sun Pharma with a target price of 1,200 rupees and Syngene with a target price of 750 rupees. IIFL also upgraded Sun to buy. According to them, it is one of their top large cap picks of 2023.
All right, that is all about the pharma space. Ekta, thank you so much for joining us with that. Meanwhile, sources told CNBC-TV18 that all marketing companies, they're hoping for 50,000 crore rupees as cash compensation from the government to make up for losses after fuel prices were frozen. Sapna Das is here with the exclusive details. Remember, the stocks of all marketing companies were buzzing in trade today. Sapna.
Well, industry players have estimated a cash compensation requirement of 50,000 crores from the government, as an immediate measure to help them make up for the losses that they've incurred on petrol and diesel in H1, Q3 also probably, and of course Q4 is ongoing. But 50,000 crores is their rough estimate in terms of the losses that they've incurred in terms of marketing of these products. That's one. The second viewpoint that's coming from OMCs very clearly is the fact that they just only can't manage to keep their head above the water and just be in a survival mode forever. Either the compensation should come through in terms of fiscal support from the government, cash fiscal support from the government, or they should be allowed to raise prices. For example, 2 to 3 rupees, price raise on diesel will help them go a long way. So these are the two demands, key takeaways from our conversations with OMCs at various points in time. This has been an important issue. It has been doing the rounds for quite some time. The government has compensated OMCs to around 22,000 crores for the LPG losses. Will they be willing to do the same for petrol and diesel losses also? That's a bit of a question mark. The matter is not closed yet, and we just have to give a watch as to how much of this money actually comes through from the government coffers.
Okay, all right. So these stocks in focus, of course, this would be a big boost if it actually comes through for all marketing companies. But with that, we'll take your leave on this edition of Markets Today. Thank you for watching.